Hi, my name is David and you're watching Critical Trading. I trade algorithmic trading systems in the US stock markets, and some of them have not been doing great in the past few months, which made me to think whether or not to try trading different markets as well, such as Canadian or Australian stocks, and what difference would it make to my systems. In this video, I'm going to share my findings with you, and if you trade US stocks, then you'll definitely want to pay attention as you'll find it useful. So let's get right into it. So let's start. I have equity curves of two of my algorithmic trading systems that I trade in the US stock market, starting from 2021. We can see that both of these systems, despite trading slightly different setups, and I'll get to that in a second, have been losing since the start of 2022 and are both in an open loss currently. Now, the question is, have these systems stopped working as perhaps the edge has evaporated from the markets, or is this simply because of the overall market? Perhaps the systems are simply not in tune with the current market, which would hopefully not last much longer, and the performance of these systems will revert back to normal. In order to find out, it may be a good idea to take these systems as they are without making any changes to them whatsoever and simply applying them on a different market. Then we'll be able to conclude whether their current poor performance is due to the market they're applied on, and perhaps whether it would be a good idea to trade them in other markets as well to improve the overall performance by diversifying across multiple markets. Now, as far as the trading systems are concerned, the first system trades volatile stocks across all US stock exchanges, which is about, I think, 12,000 stocks at the moment. It looks for less liquid stocks that have recently broken their highest high price, which is this horizontal line visible on my chart. It also uses an indicator called ADX, which you've probably heard of. It's used to filter stocks that show the highest degree of a directional momentum. The actual setup of this system is shown on the chart. It looks for a strong up day, which took place here. And then after that rule has been satisfied, the system then places a buy limit order. So it tries to buy below the current price, and to be more specific, it buys below the low of that up day. So in this particular case, it bought somewhere at this level, and then it closes the position at close of the same day. So this is a typical mean reversion system. Second system that I've done this research on is very similar but uses slightly stricter entry criteria. It also employs different execution technique where it holds positions until the close of the following day, as opposed to the first system that holds its position during one day only. This system's main setup condition is that the closing price decreases by at least 2% on previous day's closing price, which, for example, took place on this particular day that I've just highlighted on my screen. On this particular day, all other entry conditions were satisfied as well, which then resulted in an entry, and the position was closed at close of the following day. So again, your standard typical mean reversion trading system. And now let's have a look at what happens if I simply take these systems, like I said, and apply them on Canadian stocks instead of US stocks. Now, I'm not making any changes to these systems whatsoever, just trading them in a different market. The green equity curve is the original version of this system, which is traded on all US stocks, whereas the orange equity curve belongs to the version of the system that's applied on Canadian stocks. Now, just by looking at the equity curves, there doesn't seem to be anything significant popping up. The equity curves look very similar. In fact, the orange equity curve, so the Canadian market, seems to be performing even slightly worse than the original version, but we obviously can't be looking at equity curves in isolation. That's a very, very common mistake. What we have to be taken into the account are the actual performance metrics, which have in fact improved significantly. So let's have a look at that. The average annual return has actually gone down from about 24% to 18%. But don't be fooled. Again, this metric on its own has very little value and needs to be put in the context of others. For instance, the number of trades decreased, which would lower the average annual return figure, but most importantly, the Sharpe ratio increased significantly from about 1 to 175, which is a very, very notable increase. In short, Sharpe ratio essentially translates into the smoothness of the equity curve as it measures the standard deviation of returns. In practical terms, higher the ratio, the more consistent the returns are, which is objectively better for us. Overall, positively surprised with these results. But let's have a look at the equity curve of the second system that I've run this experiment on. In this case, the improvement is even more significant, as it obviously can be visible on the equity curve as well. Again, the green equity curve is the US and the orange equity curve is Canada. We can see that while the green equity curve has been getting into deeper drawdown in recent months, the orange equity curve has actually made new equity highs, which is coupled with improvement of all performance metrics across the board, especially the Sharpe ratio again. Again, it's gone up from 0.34 in this tested period to over 2. The average annual return has increased significantly, while the drawdown has decreased, which is the kind of ideal situation we're looking for here. And the other metrics improved as well. If you trade systems in US stocks yourself, try doing what I've done here and test them on Canadian stocks. You may be surprised just how much their performance may differ, and perhaps start thinking about trading them on Canadian stocks as well, similarly to myself. Thanks for watching. See you in the next one.